Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today we're taking a deep dive into the essential news from MarketWatch and Bloomberg, pulling out the most important nuggets of knowledge and insight to help you navigate the markets with a clearer, more informed perspective. It's a really packed morning, filled with major economic predictions, significant political dramas playing out on both sides of the Atlantic, and some fascinating corporate shifts. Our mission today is to cut through the noise, focusing on what these headlines truly mean for the economy and for your decisions. We'll be zeroing in on a potential economic sugar rush from upcoming tax refunds, the political earthquake hitting France, and a dramatic challenge to the Federal Reserve's independence here in the U.S.
Okay, let's unpack this and explore the connections.
Indeed, it's a remarkably dynamic landscape, and understanding these interdependencies is crucial. We'll explore these headlines, connect the dots between political decisions and market reactions, and synthesize what it all means for you, equipping you with a clearer understanding of the broader picture today. Okay, first up, let's talk about something that could put a bit of extra cash in many pockets, but also presents a significant conundrum for the Federal Reserve. MarketWatch is reporting on a potential tax refund surge coming early next year. And here's where it gets really interesting, because it's not just a run-of-the-mill refund season.
Yeah, exactly. What's truly fascinating here is JP Morgan's outlook, as detailed in that MarketWatch article. A tax refund surge is coming. How JP Morgan expects to shift economy and markets. They anticipate a significant rush of U.S. tax refunds early in 2026. This isn't just a regular refund, it's largely due to something called the One Big Beautiful Bill Act, or OBBA. This act, as the name suggests, is a comprehensive piece of legislation with 7 retroactive provisions. Think no income tax on tips, overtime, or auto loan interest, plus increased standard and child tax credits. And the key thing is, the IRS isn't changing withholding levels this year, meaning these substantial tax breaks will come back as bigger refunds or lower payments when people file their 2025 taxes. Yeah, JP Morgan estimates this translates to a whopping 110 million refunds, averaging a substantial $3,743 each. And the benefits are primarily focused on upper middle income households, those in the 50% to 90% income percentiles.
That's a staggering amount of money, potentially an enormous injection into the economy. But what are the risks here? Could such a concentrated boost, to upper middle income households actually exacerbate wealth inequality or just fuel asset bubbles rather than broad, sustainable economic growth?
That's a critical point. David Kelly, JP Morgan Asset Management's chief global strategist, he actually describes these refunds as, quote, sugar rather than protein. While they might provide a significant boost to consumer demand and inflation pressures early next year, potentially even fueling holiday spending as consumers confidently rack up credit card debt, the effects are expected to fade pretty quickly. He predicts this sugar rush will lead to a spending slowdown by the third quarter of 2026, creating a sort of boom-bust cycle in consumer spending.
So if this is just a temporary sugar rush, what does this all mean for the Federal Reserve? Especially with market expectations for rate cuts already high? Kelly's argument for delaying cuts seems quite compelling, right? But are there counter-arguments, maybe economists who would say the Fed still needs to cut to avoid a deeper downturn later?
Well, this raises a fundamental question for the Fed's strategy. While markets are largely expecting those September interest rate cuts, Kelly argues this economic sugar rush could keep growth and, frankly, above-trend inflation sustained well into next year. So this appears to be a solid argument for the Fed to, delay cuts. If they cut rates anyway, in the face of rising inflation and this refund surge, investors might doubt their commitment to stable inflation. That could lead to a steeper yield curve where long-term bonds demand higher returns, signaling worries about future inflation, a lower dollar, and potentially lower stock prices. For investors, Kelly suggests a greater allocation to international assets, ones denominated in foreign currencies, and alternative assets with lower correlations to U.S. stocks and bonds. This recommendation isn't just a suggestion, it's really a recognition that U.S. policy volatility could be a persistent theme, demanding a more resilient portfolio for you.
Right. And the Fed's independence is clearly under immense pressure from these economic forces, but it's also facing direct political challenges now, isn't it? In fact, President Trump is making headlines with a dramatic move to oust a Federal Reserve governor. How unprecedented is this, and what does it signal about the future stability of the institution?
Indeed, that Bloomberg article, Trump moves to fire Fed's cook, setting up legal fight, is a major development. Really significant. President Trump stated he had sufficient cause to fire Fed Governor Lisa Cook based on allegations of forced statements on mortgage loans. Cook, who is the first black woman on the Fed board, has refused to quit, calling the move illegal, and her lawyer plans immediate legal action. Her term isn't set to expire until 2038, so this is a significant and potentially prolonged challenge to the Fed's traditional autonomy.
Wow, 2038.
Yeah. And markets reacted immediately to this news. 30-year Treasury yields climbed, the dollar dipped, and gold rose. These movements reflect concerns about intensified price pressures if Trump is successful in reshaping the Fed. Bloomberg strategists suggest this is a kill shot at Fed independence, potentially stacking the FOMC, that's the Federal Open Market Committee, which sets U.S. interest rates with a dovish bias, meaning more members favoring lower rates. And S&P Global Ratings has even warned that political developments weighing on the Fed's independence could impact U.S. credit ratings. That's a serious red flag for global investors.
That is serious, and this is certainly creating waves far beyond Washington, D.C. It kind of connects to an ongoing theme we've seen before, trade brinkmanship. What's the broader context here with international trade relations?
That's right. This move against the Fed connects to the bigger picture of Trump's trade brinkmanship. Bloomberg also covered his threats to impose substantial additional tariffs and export restrictions on our highly protected technology and chips. This is in retaliation against other nations' digital services taxes. These taxes, levied on the revenue of tech giants like Amazon, Google, and Meta, are seen by the U.S. as discriminatory and, well, an unfair burden on American companies.
So how are other countries reacting? Are they complying with these demands to scrap their digital levies?
It's a mixed bag, really. Canada recently scrapped its digital levy, seemingly to smooth trade talks with the U.S., which shows the pressure is definitely real. However, the UK and several EU countries are currently holding firm. France's digital services tax, for example, is expected to bring in a significant $775 million this year. The OECD is working on an international solution to these digital taxation issues, but progress is slow. It leaves this as a persistent source of trade tension and market uncertainty that could continue to escalate.
Okay. But this political uncertainty isn't just confined to Washington. Across the Atlantic, European markets are grappling with their own seismic shifts. Shifting our gaze to France, it seems political drama isn't exclusive to the U.S., right? French financial markets are in turmoil over a potential government collapse.
Exactly. Billions wiped off value of French banks with Bayrou-led government on verge of collapse, from MarketWatch, and French Premier risks government collapse as opposition grows. From Bloomberg. These are major headlines this morning. French Prime Minister François Bayrou is facing a critical confidence vote on September 8th over his austerity plans, and, well, he's widely expected to lose. This immediate political instability has already sent French banking giants BNP Paribas and Société Générale seeing billions wiped off their market value, just like that.
That's a rapid and significant impact. What are the immediate market signals telling us about the broader European economy, beyond just French banks? Is this contained?
The market signals are pretty stark. And no, it doesn't look contained. The CAC 40 index, France's benchmark stock market index, tumbled. And even more tellingly, the yield spread between French and German 10-year debt widened to its highest close since April. This widening spread is a crucial indicator. It highlights a sudden return of fiscal concerns and increased perceived risk in French government bonds compared to German ones. Finance Minister Eric Lombard has even warned that France's borrowing costs could surpass Italy's within 15 days if the government falls. This underscores a concerning two-tier Europe where some countries have the fiscal flexibility to spend on growth, while others, like France, are increasingly forced into painful financial consolidation. For you, this isn't just about French banks. A destabilized France sends ripples through the entire EU.
Yeah, it challenges that whole idea of a unified European economic front. Could affect trade, currency strength, maybe even the cost of goods we import from Europe.
Precisely.
Okay. It's clear that political risk is a major theme this morning. Stepping away from the direct political headlines for a moment, how is this broader global instability impacting other key markets? Specifically, let's talk oil and China.
Well, this political and economic instability isn't isolated. It's reverberating through global commodity markets. Oil prices, for instance, are declining. That's in Bloomberg's oil declines as traders gauge Fed turmoil and Russia risks. Brent crude, the global benchmark, fell near $68 a barrel, and WTI West Texas Intermediate, the U.S. benchmark, traded near $63. Geopolitical volatility, including the U.S. doubling tariffs on Indian imports for buying Russian crude, that's a significant factor. Also, the International Energy Agency warned earlier this month of a record global oil surplus next year, which is certainly contributing to this downward pressure as well.
Right. And how is this impacting major players like PetroChina, especially with their exposure to both global prices and, domestic demand?
It directly impacts companies like PetroChina. Their first half profits slipped from a record high, falling to 84 billion yuan, which is about $12 billion, compared to 89 billion last year. And Bloomberg's PetroChina profit slips from record after oil prices tumble, says this was a direct result of falling crude prices and, crucially, flatlining domestic oil demand in China. Their gas division, however, was a bright spot, showing some resilience.
Okay, so zooming out from energy, what about consumer sentiment in China more broadly? Is the economic slowdown impacting how everyday Chinese consumers are spending their money?
Absolutely. The Bloomberg article, Chinese cosmetics maker Proya Sales Miss Plans HK Listing, offers a telling insight into Chinese consumer sentiment. Proya Cosmetics, a major domestic brand, saw its half-year revenue miss analysts' estimates amid growing competition and weaker consumer demand. Their plan to list shares in Hong Kong for global expansion shows that even affordable brands are feeling the pinch from the economic slowdown at home.
Interesting.
And it's not just cosmetics. Similarly, Ping An profit falls as slowdown, market volatility hurt returns, also from Bloomberg, reports Chinese insurer Ping An's net income dropped 8.8% to 68 billion yuan in the first half. This was primarily due to the double whammy of stock market volatility and lower interest rates stemming from China's broader economic slowdown. Both these examples really underscore how sensitive the Chinese consumer is to these economic shifts.
Which has global implications given China's role as a consumption engine.
Exactly.
Okay, while some regions face headwinds, capital is always looking for opportunities, right? There's an interesting story out of Africa and India that seems to highlight global capital flows seeking growth.
Indeed. Africa's Madhvani, in talks with Cerberus for Indian M&A loan by Bloomberg, highlights a fascinating trend in global capital allocation. Uganda's Madhvani Group is seeking a substantial $190 million private credit loan from Cerberus Capital Management. And the goal? To acquire an Indian glass bottle maker. What's more, Madhvani plans to invest $1.1 billion in India over the next 5 years. It really underscores India's boom in private credit investments, which increased an impressive 53% to $9 billion in just the first half of 2025. This shows where capital is finding opportunities amidst global uncertainties, often away from the more traditional markets.
Right, suggesting the growing importance of emerging markets and perhaps alternative financing in today's investment landscape for you, the listener.
Definitely.
Okay, let's turn back to the U.S. for a moment, where we're seeing a fascinating disconnect. It seems what companies are saying is at odds with how Wall Street is actually feeling. Bloomberg's Corporate America's buoyant tone at odds with Wall Street angst digs into this. What's behind this divergence?
Yeah, this raises an important question. Why are companies so optimistic while investors remain skeptical? Jefferies LLC analysis shows 44% of S&P 500 companies raised revenue outlooks this quarter. That's the highest percentage since 2021, with only 14% downgrading. Management teams are generally only raising guidance if they are very confident, which in theory should be powering stocks higher. However, despite this seemingly benign revenue outlook, investor skepticism remains high. This is primarily due to signs of labor weakness, elevated inflation persisting, and frankly, the current lofty stock valuations. Matt Maley of Miller Tobacco & Co. points out that while earnings growth will likely be good, it just may not be enough to justify today's already expensive market.
So it's not just a simple case of good news equals rising stocks. The underlying strength might be there, but the market's weighing it against other big concerns. What other factors are at play here, supporting this corporate optimism despite that investor caution?
Precisely. Buybacks are also playing a significant role in supporting equity markets. Announced buybacks are at their highest in 3 years. This reduces the number of shares available, which mechanically boosts earnings per share. And Goldman Sachs notes, S&P companies' economic activity, specifically real revenues excluding energy, rose 4.8%. That actually exceeded overall economic growth. So while the underlying corporate health appears strong, the broader economic headwinds and existing valuations create a complex picture for you to consider. The market is trying to balance that corporate strength with potential macro vulnerabilities.
Right. Okay, finally, let's look at a topic that directly impacts households and businesses across the board: surging electricity prices. Barron's has a deep dive into the political fallout and what it means for companies. This is something pretty much everyone is feeling.
Yeah, this is a big one. Barron's article, Electricity Prices Are Surging: How the Political Fallout Could Hit Companies Too, reports that residential electricity rates have risen about 30% since 2021. That includes a 5.5% increase in just the past year alone. And the Energy Information Administration projects another 6% rise in 2026. This is a problem for literally everyone, from individual consumers paying their bills to huge renewable energy developers and the utilities themselves.
President Trump has been quite vocal on this, hasn't he? Blaming renewables for the rising prices. Is that the full story here, or is there more to the equation?
Well, it's a very politicized issue, as you'd expect, and the evidence doesn't always neatly support the claims. While President Trump blames renewables, data from states like New Jersey, which has almost no wind power, or Texas and Iowa, which have surprisingly low prices despite high percentages of renewables, seems to refute this simple link. Consumer advocates argue that Trump's own policies, like tariffs on imported materials or forcing old fossil fuel plants to keep running past their economic lifespan, are adding significant costs. For example, they cite a Michigan coal plant that cost $29 million to operate for just 5 weeks due to an emergency order. But beyond the politics, Charles Hua of Powerlines highlights that major infrastructure investments think transmission and distribution grids are actually the biggest drivers of these rate increases, not necessarily the energy source itself. It's complex.
No single culprit, then. So, given these rising costs that everyone is grappling with, what's a potential, maybe unconventional solution being discussed to help bring these prices down?
An interesting idea that's gaining some traction comes from Tyler Norris, a Duke University fellow. He suggests tech companies could actually reduce the need for more power by coordinating to shut down data centers for a few hours during peak electricity demand times. The thinking is this could reduce costs for everyone, businesses, industries, and regular consumers like you, by lessening the strain on the grid during the most expensive periods. It's a kind of demand-side management approach.
Interesting. And quickly before we wrap up, there was a note on UK bonds from MarketWatch.
Yes, just briefly. The UK bond market is described as drifting without anchor. The 30-year gilt yield, that's the yield on a long-term UK government bond, hit a 27-year high of 5.61%. This follows Chancellor Rachel Reeves' team reshuffle ahead of her crucial autumn budget, so yet another spot of global instability to keep an eye on. So if we connect all this back to the bigger picture, today's headlines really reveal a profound and pervasive interplay between political mandates, central bank independence, and the very real economic consequences for global markets and your daily life. From the promise of tax refunds to the realities of trade wars, the stability of a central bank, the price of your electricity, political decisions are increasingly shaping financial realities across the globe. This raises an important question for all of us. How adaptable and resilient are our global economic systems in an era where political intervention seems to be constantly shifting the goalposts and creating new sources of uncertainty?
It really makes you wonder about the long-term implications for stability, doesn't it? And perhaps it compels us to think about how we can better prepare our portfolios and just our understanding for such a dynamic future. Something for you to mull over as you go about your day. That's all the deep dive we have for you today on the major financial magazine headlines. We hope this has given you a clearer, more informed perspective on what's driving the markets right now. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.